بسم الله الرحمن الرحيم، والصلاة والسلام على أشرف المرسلين سيدنا محمد نبي أمي وعلى آله وصحابته أجمعين. أما بعد, dear my students, today we are going to investigate one of interesting topic in finance and investment management. This topic is under the following title: bonds and stocks valuation. The main outline of this chapter, we are going to give a definition of a bond and giving examples of different types of bond. Then we are going to estimate the value of bond, explaining some terms and the concepts related to bond. Then we are going to explain how could we determine the present value of common stocks, investigating one of the important financial model. It is called the dividend growth model. First of all, for valuation of bonds and stocks, first principles, you must have the following idea. Valuation, it means that we are seeking to assess the market value of financial securities. When I say valuation of bonds and stocks, it means that we are interested to determine the market value of financial security. This means that we are seeking to determine the present value of the expected future cash flows related to this security. To value bonds and stocks, we need to have the following information. Number one, we need to estimate future cash flow related to this type of bond and stocks. This implies that you need to know what is the size, how much is this future cash flows, and you need to know timing when this future cash flows will occur. Then you need to have also the discount rate that would be used for discounting these future cash flows. When I say discount rate, this rate should be appropriate to the risk presented by this security. This means that if you would like to assess the market value or the present value of a specific bond and stock, you need to have an estimate of future cash flows regarding the size and the timing of those cash flows, and you must have the discount rate, which is a reflection of a degree of risk attached to this security. To explain how could we evaluate a specific bond, we need to explain what is the meaning of bond. Bond can be defined as a legally binding agreement between borrower and a lender. This type of agreement should specify the principal amount of this loan and bond. Also, this agreement should specify the size and timing of these cash flows. This could be in a shape. Also, you need to specify appropriate discount rate. This appropriate discount rate could be at a fixed rate, so we could say this is the fixed rate borrowing, or this rate is not fixed, but it will be adjusted from time to time, and this will be known as adjustable rate borrowing. When we are explaining bond, you must aware of the following terms related to bond. The first term is the coupon. What is a coupon? It is the stated interest payment made on a bond. Also, you must aware what is the face value. This face value, it is the principal amount of a bond that is repaid at the end of the term. Sometimes we refer to it by par value. The third term related to bond, it is called the coupon rate. And this coupon rate is very necessary to determine the amount of coupon that you are going to pay for this type of bond. The coupon rate can be determined by the annual coupon divided by the face value of this bond. Also, one of important expression related to the bond, it is called maturity. Maturity is a specified date on which the principal amount of this bond is going to be paid. Finally, yield to maturity, YTM. YTM, yield to maturity, it is the rate required in the market on bond market. How to value bonds? As I told you, you must first identify the size and timing of cash flows. Also, you must aware of the discount rate that reflect a specific type of risk related to this type of bond. If you know the price of the bond and the size and the timing of cash flows, and the yield to maturity can be considered as a discount rate, it will be very easy to assess the market value or the present value of this bond. When we are saying bond, actually we could classify bond into different types. One of the very famous type of bond, it is called pure discount bond, or sometimes zero coupon bond, or sometimes we refer to it by zeros. With the first type, it's pure discount bond or zero coupon bond or zeros. In this type of bond, actually we don't have any type of coupon related to this type of bond. What we have, we just know what is the maturity, we just know what is the face value, and we know what is the discount rate. If you have this information, it will be very easy for you to determine what is the market value or what is the present value of this bond. Example, imagine that we have zero coupon bond with a maturity of T. As you see, at the end of each year, we didn't have a coupon. As you see, at the end of the first year, we have zero coupon. At the end of the second year, we have a zero coupon, and so on. Till the end, which is the maturity date, we are going to have what we call the face value or the bar value of this bond. To determine the present value of this face value or bar value, we are going to implement the following equation. BV equals F, this is the face value at maturity date, discounted by 1 plus R, this is the discount rate. Sometimes it's a reflection of the yield to maturity in bond market. Power to T, this is a duration T, a time of this bond, which is a reflection at time to maturity. By implementing this equation, it will be very easy to determine what is the present value of bond. Let us take an example. Imagine this find the value of a 30-year zero coupon bond. This is the time to maturity date. We have about 30 years. This bond with a face value or bar value 1,000 and a discount rate, which is a reflection of a yield to maturity of 6%. As you see, from 0 to 30, at the end of 30 years, we are going to have 1,000 as the face value, but at the end of each year, we don't have any type of coupon because this is zero coupon. But to determine a BV, BV equals F divided by 1 plus R power to T. F is 1,000 discounted by 1 plus 0.6 power to 30. As you see, the market value or the present value of this bond is 174.11 US dollars if you would like to invest in this type of bond. Another shape of bond, we refer to it by levy coupon bond. In this type of bond, we are going to receive two types of cash flows. The first cash flows is a certain type of coupon payment. We are going to receive it periodically. This coupon could be daily coupon, could be weekly, could be monthly, could be quarterly, could be semi-annual coupon, could be annual or yearly coupon. In general, the most common type of coupon is the semi-annual coupon bond. The second cash flow that we are going to receive, if you are going to invest in this type of bond, you are going to get the face value at the end of a maturity date. But as you see, give a look for a timeline here. We have a bond has a maturity at a specific time T capital. As you see, for example, if we have annual coupon, this means that at the end of each year, we are going to receive a fixed amount as a coupon, CCC, and at the end of a maturity date, you are going to get also the face value. But as you see, to determine the present value of this type of coupon, you must determine the present value of two cash flows, a BV of coupon payment annuity plus a BV of face value. But as you see, since you are going to have a fixed coupon over a fixed period of time, this is an annuity cash flow. To determine its BV, this will be done by C over all multiplied by 1 minus 1 discounted by 1 plus R power to T. This, the first part of the equation, is the part that is used for estimate the BV of coupon payment, since it is in a shape of annuity, plus a face value discounted by 1 plus r power to t, and this is the BV of coupon bond. Let us take an example of coupon bond showing you that how could we determine its BV. Example, find the present value of a specific coupon. This coupon started January 2004. This coupon has a coupon interest payment of 63/8. This is a coupon T bond with a semi-annual payment. Maturity date of this bond is December 2009, and the YTM of this bond market is 5%. As you see, we have two rates. The first rate can be defined as a coupon rate, and this coupon rate can be used to determine the amount of the coupon that we are going to receive. How could we determine the coupon value? This can be determined by multiplying the coupon rate by the face value or the bar value of this bond. As you see, 6/3/8 can be converted to be in a decimal case to be 6.375%. This percentage will be multiplied by the face value, which is 1,000. So this will give an amount of 3,675 divided by 2. So this will give you what we call 31.875. This is the amount of coupon that we are going to receive it as semi-annual coupon. After you determine the semi-annual coupon that you are going to have every 6 months, we are going to explain a timeline. As you see, timeline, we are starting at January 2004, and the maturity date is December 2009. This means that every 6 months we are going to have 38.875, and at the end of a maturity date, which is December 2009, we are going to have the coupon plus the face value. To determine the BV of this bond, we have two types of cash flows: coupons as the first cash flows of this bond, and the face value that we are going to receive. Let us implement in the equation. Our equation is BV equal C over R. C, this is the coupon payment. In our case, our coupon payment is 31.875. This is the semi-annual coupon, divided by R. This is the YTM. But a YTM is the annual YTM. But since we are having semi-annual bond, we must divide the annual interest rate by 2, so it is 0.5 divided by 2, multiplied by 1 minus 1 over 1 plus R. R also should be divided by 2, so it is 0.25 power to T. T time to the maturity is 6 years, but this coupon is paid every 6 months, so T will be 12. 6 multiplied by 2. Plus, we have the face value, 1,000, divided by 1 plus 0.25 power to 12, because this is the semi-annual coupon bond. As you see, the BV, it is 1 1070.52, 1070.52. This is the BV of this type of bond. We have a specific concept attached to a bond, and you must be aware of this concept if you would like to invest in bond market. The first rule that you must aware is bond price and market interest rates move in opposite direction. This means that we have negative relationship between bond prices and interest rate. If there is increasing in interest rate, this will lead to decrease in the bond price or market value of this bond. The second rule, the BV of the bond will be determined through the relationship between coupon rate and the yield to maturity. So the relation between coupon rate and YTM, it will be a very important role in determining the BV of the bond. How it is? Imagine that the coupon rate equals YTM. In this case, the present value of the bond will equal its face value or bar value. If the coupon rate is more than YTM, in this case the market price should be higher than its bar value. In this case, if a market price of the bond is more than its bar value or face value, this type of bond will be considered as a premium bond. So when you hear some professional telling you that this bond is a premium bond, it means that its market price is more than its bar value. However, if the coupon rate is less than YTM, in this case the market price is low than its bar value, and this type of bond, it is called discount bond. The third rule that you must aware of a bond concept, that a bond with longer maturity, it has higher relative price, exchange price, than another bond with shorter maturity. So longer maturity, a percentage of change in its price is higher than a change in the price of shorter maturity when a YTM changes, with assuming that all other features are identical. The fourth rule, a lower coupon bond has a higher relative price change than a higher coupon bond when YTM changes by and assuming all other features are identical. And you must be aware of these rules to understand the bond market. Here, this is a figure. In this figure, we are going to explain the relation between YTM and coupon rate. Here, give a look. We have two axes. X-axis, it's a reflection of YTM, discount rate, and Y-axis is a reflection of bond value. Give a look. By increasing the discount rate, you could note that there is a drop in the market value of this bond. As you see, when we are moving from 0.1, for example, to have a discount rate of 0.6, you could note that there is drop in the bond value of this bond. If we will continue further, you will find that the market value of your bond, it is started to be less than its face value or buy value. Therefore, based on this figure, we could conclude that if YTM is more than the coupon, in this case, we could say that this bond is traded at a discount. But if a YTM is less than the coupon, we could say that this bond trades at a premium. If a YTM equals the coupon rate, in this case, we could say that this bond trades at par, and this is a very important rule, and you must aware of it. Also, the following figure is going to explain the relation between long-term maturity bond and short-term maturity bond, by assuming that other variables are identical in both bonds. We could conclude that the long maturity bond will have much more volatility with respect to changes in the discount rate. But in the case of long-term maturity, you could find that the volatility in changes in bond price is higher than the volatility of short-term maturity bond regarding changes in discount rate. Also, the coming figure, it's used to explain the relation between coupon rate and bond price volatility. As you see, we have two types of bonds. One of them is high coupon bond. The second one is low coupon bond. We could argue that the low coupon bond will have much more volatility with respect to changes in the discount rate. And if there is a change in the discount rate, the high volatility will be existed in the case of low coupon bond rather than high coupon bond. But by the end of this part, we explained what is the meaning of bond. We explained different types of bond, and we explained how could we assess the present value of each one of them and what are the required informations if you would like to assess the bond value. Let us now move to the second part of this lecture, which is the valuation of common stocks. As you see, in the case of stocks, you could have two different types of cash flows. One of them, it's called dividends, and this will be based on a decision of a board of directors, whether they and it's based on a dividend policy of this firm. The second type of cash flow is the capital gain, which is related to the market, whether we having increase in the market price of the stock or whether we are facing a drop in the market price of the stock. Let us investigate key characteristics of the first type of cash flow, which is dividends. Dividends can be considered as a distribution of corporate profits to eligible shareholders. Second, dividends payments and amounts are determined by a company board of directors. Dividends are payment made by publicly listed company, and they can be considered as a reward to investor for putting their money into this venture. Announcement of dividend payout are generally accompanied by a proportion, sometimes could lead to increase or decrease in a company stock price. But such a type of announcement of the dividends payout play a very important role in affecting the company stock price. Many companies don't pay dividends, and instead they are retaining these profits as a certain type of retained earnings to be invested back into the company. Let us now move to discuss the main characteristics of capital gains. When I say gain, this refers to an increase in capital asset value, and capital is considered to be realized when the asset is sold. But capital gain, it's based on increasing the capital asset value and at the process of selling such a type of stocks. Capital gain may be short term, less than 1 year, or maybe long term, more than 1 year, and must be claimed on income taxes. And you are going to pay taxes on your capital gains. Sometimes this gain could be considered as unrealized gains and losses, and this referred to as the paper gain and losses reflect an increase or decrease in an investment value, but are not considered a taxable capital gain because we didn't actually sold it. A capital loss, it's incurred when there is a decrease in the capital asset value compared to an asset purchase price. As you see, holding a specific stocks, you could achieve certain type of capital gain, or you could achieve a certain type of capital loss. The question is how we could evaluate the market price of a specific stocks. In this case, we have three different types of common stocks. We have zero gross, and we have constant gross, and we have differential gross. Let us start by the first case, zero gross case of common stocks. It assumes that dividends will remain at the same level forever. Yani there is no gross in the amount of dividends that we are going to pay for a specific assets. In this case, we assume that DIV at the end of the first year equal DIV dividends at the end of the second year equal DIV at the end of the third year, and so on forever. In this case, such a type of dividends can be considered as a certain type of perpetuity cash flow. So if you are interested to determine the BV of zero gross stocks, we could deal with it as determining the BV of a perpetuity. In this case, the B0, the market price of this zero gross stock, will equal to a DIV, a dividend, divided by R, which is the discount rate or interest rate existed in a specific market. Another case of stock, it's called constant growth. In this constant growth, we assume that dividends will grow at a constant rate at G, which is growth rate, forever. But this means that we have a dividend, but this dividend, it's not constant, but this dividend is growing from 1 year to another year at a constant growth rate G. In this case, DIV at the end of the first year, it will equal to dividends at the current DIV 0 multiplied by 1 plus G, where G, this is the growth rate. The same situation, DIV 2, it's equal to DIV at the end of the first year multiplied by 1 plus G, which is equal to DIV 0 multiplied by 1 plus G power to 2. The same situation, DIV 3, it's equal to DIV 2 multiplied by 1 plus G, which is equal to DIV 0 multiplied by 1 plus G power to 3. And so on. So accordingly, if we would like to generalize this case, we could consider it as a certain type of growing perpetuity. So but in this case, if it can be considered as a certain type of growing perpetuity, so we could determine the BV as follows. BV or B0, it will equal to DIV at the end of the first year multiplied by R minus, discounted by R minus G. But again, BV or the present value, it will equal to DIV1 divided, discounted by R minus G, where R, this is the interest rate, G, this is the gross rate. So we could say that B0, it's equal to DIV 0 multiplied by 1 plus G divided by R minus G. The third case of stock valuation, you could have a stock has differential gross. Differential gross means that you have a stock giving dividends, but this dividend is growing at different rate in the foreseeable future. But in this case, for example, you could have a stock. This stock is going to grow at a specific growth rate for instance 3 years, and later it will grow at a constant rate forever. But in this case, if you have different gross rate for a specific stock, this will be known as a differential gross stock. How could we determine its BV? First, you need to know what is the future dividend in the foreseeable future, and then you need to estimate the future stock price when the stock becomes a constant gross stock, and then you are taking a sum by a total present value of the estimated future dividend and the future stock price at the appropriate discount rate. To explain this in details, let us taking you this. Imagine that, assume that a dividend will grow at a specific gross rate, G1, for a specific number of years. And later, it will grow at another gross rate, G2, forever. In this case, DIV, we have 2 times. From 1 to n, this is a specific growth rate, G1, and then after N, which is N plus 1, it will grow at another growth rate, which is G2 forever. But in this case, to determine a dividend at the end of the period N, a dividends at N, it will equal to a dividends N minus 1 multiplied by 1 plus G1, or it is equal to a dividends at N is equal to div 0 multiplied by 1 plus G1 power to N. Then later, after N, we have another growth rate, which is G2. But in this case, div N plus 1, it will equal to div 0 multiplied by 1 plus G1 power to N multiplied by 1 plus G2. This is if you are interested to determine what is the amount of dividend in the two cases. After we determine this at the two cases, you are going to determine the BV for each one of them. You could determine the BV for the period from 1 to N, which grows at a constant growth rate G1. In this case, B at the first period, it's equal to C, which is the dividends, divided by R minus G1, multiplied by 1 minus 1 plus G1 power to T, divided by 1 plus R power to T. Plus, you must add what is the BV of the growing at the second period of time at a second growth rate, which is G2. But in this case, the B at the period 2, it is equal to a dividend N plus 1 discounted by R minus G2 divided by 1 plus R power to N. So by taking a sum of two cases, BV at A and the BV at period B, our equation, if you have a differential growth rate of two growth rate, for example, G1 and G2, in this case, you could determine the BV as follows. BV is equal to the dividends div 0 discounted by R minus G1. B is equal to C. This is a cash flow at the end of the first year, which is div 0 multiplied by 1 plus G1 divided by R minus G1 multiplied by 1 minus 1 plus G1 power to T divided by 1 plus R power to T, plus a BV at the second period with the second growth rate, which is G2. But in this case, div at N plus 1 discounted by R minus G2 discounted by 1 plus R power to N. This if you would like to determine the BV of differential growth rate. Let us take an example showing you how could we estimate the BV in the case of differential growth example. Here, this is the common stock. This common stock is just paid dividends of 2. This dividends is expected to grow at 8% for 3 years. This is the first growth rate, G1, and then it's expected to grow at G2 of 4% in perpetuity. Specify what is the stock value if the discount rate is 12%. As you see, we have 2 periods of time from today to the end of the third year. We have a specific growth rate of 8%, and then after the 3 years forever, we having another growth rate G2 of 4%. To compensate in our equation, B is equal to C. As you see, C, to determine C, this is the dividends of today multiplied by 1 plus G1 to determine the amount of dividends at the end of the first year, divided or discounted by R minus G1 multiplied by 1 minus 1 plus G1, which is 0.8 power to 3 divided by 1.112 discount rate power to 3. At the second part, after the 3 years, we have another gross rate of G2. But in this case, we are taking dividends at the end of N, which is 2 multiplied by 1.08 power to 3 multiplied by 1 plus G2, which is 4%, discounted by R minus G, which is 12% minus a 4%, discounted by 1 plus R power to N, which is 1.28 power to 3. By taking a sum of two parties, we could say that the BV of a stocks, it is 28.89, and this is how could we estimate the differential gross stock example. Now let us move to one of the very important one. It's called dividend gross model. In this dividend gross model, it's assumed that the dividend gross model, it's assumed that the BV of a specific stock, it is dividends at the end of the first year divided by R minus G, and this is one of the very famous model used in estimating the market price of a specific stock. But if you are interested to determine the market price using dividend gross model, you must have a dividends at the end of the first year divided by a difference between the interest rate minus a gross rate, and then you could determine its BV. Again, by the end of this part, you must be familiar with what different cash flows related to stocks. We have two types of cash flows, dividends and the capital gains. Then you must aware that different types of stocks, zero gross rate, constant gross rate, differential gross rate, and then you must aware of the dividend gross model. How could you implement this model in estimating the market price per share? At the end of this lecture, I wish for you all of the best, and see you inshallah ta'ala coming lecture with my best wishes.